Welcome to the Money Movement. I'm super excited today to be joined by Nic Carter. Nic, great to see you again.
Thanks for having me, Jeremy. Hello.
Yeah, awesome. There's so much I want to talk to you about. And I enjoy whenever I see you, hear you, when you're tweeting, all kinds of stuff. You're just, I think you've got such fresh and fun perspective on a lot of things and very deep perspective on a lot of things. So thank you for making the time for having this conversation today.
Of course. Yeah. Second time.
Second time. I know. Watch out. Third time's a charm. We'll see when that happens. Bitcoin at 1 million,
We'll get there.
Yeah, no, absolutely. So for just very as a refresher, like very quickly, for folks that are listening or watching, maybe do the 30-second who is Nic Carter for a moment, and then we'll dive into some of the key themes.
Sure. So general partner at Castle Island Ventures. We are seed and Series A venture firm focusing on startups in the public blockchain industry. Based in Cambridge, Massachusetts. I'm in Miami, so I recently decamped down here. Rest of the firm is mostly in the Northeast.
Yeah, we like to say our headquarters is the internet, and so we no longer say it's Boston or this or that because it's actually like pretty distributed now, right?
It's the metaverse. Yeah,
the metaverse. I guess I should change it to the headquarters is the metaverse.
Yeah, and I mean, speaking of distributed, also co-founded Coinmetrics, which is a crypto data company, which is fully distributed by design. And we did that, long before COVID struck, and we sort of had a feeling that might be the dominant model going forwards, and that turned out to be the case.
Yeah.
So those are sort of the main two things that I do.
That's awesome. I want to come back to distributed economic organization and on-chain economic organizations and kind of the experiments, the huge laboratory we have around that, but that's maybe for later in the episode. I mean, look, I think one of the things that you're really well known for is you have a very deep, long conviction about Bitcoin, and among many other themes. And I thought it'd be interesting to just start with, your most up-to-date narrative on your core long thesis on Bitcoin. And I know for a lot of people, it's sort of like something that people have had strong conviction about for a very, very long time, but it sort of continues to get refined as the world evolves. As we're seeing, as Bitcoin reacts to the world and the world reacts to Bitcoin, it's truly fascinating, right? Because we just achieve these new milestones, not just price, but other things that just blow our minds. Like I know you were involved really early, but maybe just talk about your long thesis there. Where do you think we are on that today? How soon will the majority of G20 central banks hold Bitcoin on their balance sheets?
Yeah, no pressure. Wow. It's funny. I don't get asked that much anymore. My updated long thesis on Bitcoin. But yeah, I'm still bullish Bitcoin. I guess we should periodically ask ourselves, has Bitcoin met the thresholds or do we expect it to meet? And where is it in its growth cycle? And I think it's matured a great deal. So, I wouldn't say it's an early, highly asymmetric bet the way it was 3 or 5 years ago. I mean, it's got a huge amount of traction and momentum, and the return profile looks different today. But I still think it's obviously a great thing to own, especially on a forward-looking basis, confronted with sort of the macro outlook, and what seems likely from a kind of debt monetization and inflation perspective here. So I continue to obviously own Bitcoin and happy to do that for the foreseeable. in terms of sort of updated narratives, I think right now Bitcoin is pretty exposed to what happens in the broader macro context. And that may not be the most comfortable situation to be in, but I think it is the case. So if you look at the correlations, it's not sort of highly correlated with risk on assets, but it has had periods of positive correlation in the last 24 months, especially throughout 2020. That was perturbing to me because, I don't really want to see it behave like a Tesla or a risk on asset. I wanted it to, not that I can sort of mandate anything about its return characteristics, but I was nervous that it would end up being like a risk on asset and then just sell off if anything adverse happened. So it has had those periods of positive correlation, and which causes a lot of, I think, smart people to dismiss it as a portfolio hedge or anything like that, because it doesn't really act like a hedge.
We've seen like so many more quote unquote significant global macro investors, asset managers who come out saying there's a role for this. Here's how to think about it. It's a macro hedge, and that's been like one of the stories of the last year is, Ray Dalio's got a position in Bitcoin, blah, 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 like, all that kind of thing. And it's just sort of how much of what it is today is sort of a risk on asset versus a true high conviction kind of long-term hedge asset. It's hard to differentiate that, obviously.
Yeah, that's actually my greatest concern is that it is too risk on, and it's too exposed to a very loose liquidity environment. And when liquidity tightens up, that gets withdrawn from Bitcoin rapidly. And obviously in March 2020, that was exemplary of that, where Bitcoin sold off harder than equities.
Right.
But, all that said, the traditional thinking we have around 60-40 portfolios and normal hedges doesn't apply anymore. It's not applying. So, people think the stocks and fixed income tend to be anti-correlated, but we've seen them selling off together in the last year or so.
Liquidity sort of becomes the prime motivator in those situations. Yeah.
Yeah. So these theories that people have that they learn in business school or the CFA about the correlation characteristics and the efficient frontiers, they're not really holding up anymore. So I think we kind of need new thinking around how to construct your portfolio, especially as we enter in this period of potentially very, very negative real interest rates.
Yeah.
Which I think is where we're going. It's sort of where we have to go. I don't see an alternative. And in that world, if real rates go to -10 or deeper, I know that sounds extreme, but I could absolutely see it happening. I think your store value assets that are custom built to resist monetary repression, whether it's Bitcoin or gold, they do very, very well. And in the 70s, you saw gold, do multiples in terms of its return profile in real terms as it became monetized as this asset that people use to protect themselves from inflation effectively. And, not to return to this sort of trite analogy of digital gold, but I think Bitcoin, is gaining consensus as an asset that is really suitable to resist a new monetary repression that's emerging.
Yeah, I mean, and obviously, like it has just dramatically more utility value, and is actually like a financial primitive and an instrument that is extraordinarily useful in so many ways versus other traditional hedge assets, which are paper based, or they're sort of you're not really owning them, and they don't have any actual utility, right?
So that's sort of the really key difference for me, is that you can take your physical ownership of your Bitcoin physical, whatever the digital version of physical is, but you can really possess it, and that is much unlike virtually any other financial asset out there.
Yeah. So do you think the rumors of Putin accumulating Bitcoin and Ether are true?
Well, if I were him, I wouldn't disclose it until I had my position in place, right?
Yeah, clearly.
Because
Yeah.
you want to monetize it after you have accumulated. But yeah, I think it would be prudent for every central bank to determine what percentage of the world's gold they own and then acquire that exact same percentage of Bitcoin at a minimum.
Yeah.
Because you don't want to be any worse off than you were under
Right.
the old regime.
Right. I mean, we've seen this, right? We've seen, obviously it's like this risk on environment. We can argue about that, but we've seen this sort of, I don't want to say it's an inversion, but, sort of Bitcoin store of value, just basically radically outpacing gold and gold underperforming. But despite the macro and monetary inflation risks and debt monetization risks and everything else, gold is not performing. And it does feel like there's been this rotation. And you have to assume, if that's the case for a retail investor, an institutional investor, an asset manager, that would be the case for a central bank balance sheet as well.
And I'm not against gold, actually. I don't like it when Bitcoiners feud with gold bugs or anything like that.
Of course.
I think that we're pretty much on the same team. We just have different ways of expressing our opinion, which is generally the same opinion. And I think it's counterproductive to fight. But I mean, if you just look at what's happening, like both central banks and, pension funds and other enormous pools of institutional capital, ex-US, they are divesting dollars and dollar assets.
Right.
And well, there'll be an interesting conversation about how stablecoins fit into all that, but they're certainly divesting themselves of treasuries.
Yeah.
And, if you just look at what is happening, like China stopped buying treasuries, I want to say in 2014, maybe even before that. Generally speaking, foreign official buyers stopped buying treasuries in the last decade, and they've been net sellers. You've got Russia saying they want to divest all their dollar assets. You've got Russia, Mexico, China, Japan, like they're not buying US debt anymore. And the Fed is making up the difference by basically buying the debt.
Right.
And Lynn Alden has this great analogy. She says it's like the chef eating his own cooking. It's like very circular. And that's not sort of the basis for, a functional restaurant economy.
Well, they're supposedly going on a diet announced later this afternoon. We'll see.
Yeah, it might be like, one of my diets, like very short-lived, And if you look at what they're doing, they're buying a lot of gold. Their central banks are buying a lot of gold, and we're not seeing that expressed in the price of gold, but I think it's very indicative. There's still a role for non-state, whether it's inflation resistant or negative rate resistant goods. And, I don't think central banks need to despair. They have plenty of time to get a Bitcoin position that has parity with their gold position, because Bitcoin is still worth 10 times less than gold. So they've got all of that time while it's still monetizing to get off zero. And it's not like no countries own Bitcoin officially. Like, I think there are 4 at least. One we know for absolute certain, El Salvador owns Bitcoin. And then you have a few pariah states that it's sort of heavily rumored or hinted.
Right, they're mining or they're using their own like cyber attacks to go seize some or whatever it is.
I mean, it's not like the names you strictly want to be co-investing with, but they've understood that this is a thing that they can truly own, and the U.S. can't sort of confiscate from them very easily.
Well, there's so many things to ladder off of that. A lot of those thoughts. And I think one is, sort of how far down the curve of crypto assets how many of these crypto assets will be commodity money, right? And obviously the ETH maxis feel very, very strongly that ETH is a superior form of digital commodity money. It functionally and things like that. And there's obviously the rollover that's coming into the new version, or kind of almost new version of Ethereum, and kind of arguing that it will have these deflationary characteristics, and it has more utility value and so on. I mean, I don't want to drag out from you like, this is better than this. That's not my goal at all. But is there a portfolio construction mechanism here from a sound money, non-sovereign commodity money perspective in this space? And I'm using nation states as a proxy for kind of how the whole world might adapt and think about these things over the long run.
Yeah, it's a great question. I mean, it is very Hayekian to have a world of dueling. Actually, what Hayek wanted was a number of sort of fiat monies that were competing,
right.
But sort of privately issued
right.
fiat monies, competitive. And he thought that they would compete on actually their price stability characteristics.
Yeah.
So their ability to hold value. And of course, it's interesting that now we have commodity monies, digital commodity monies, competing on how deflationary they can be,
right?
Which is actually sort of not what Hayek thought would happen. And so in some senses, his vision is actually much more consistent with the world of many different competing stablecoins that have different units of account.
Yeah.
So it might be the dollar, one might be indexed to CPI, one might be to commodity basket or something.
Whatever it is, or they're based, they're pricing effectively the risk of the reserves in different ways, right?
Right.
Whatever that is, yeah.
But when he wrote it, it was sort of quite theoretical. And
that was one of the things I read back in 2012. As I was like trying to think about all this, and I extensively read von Hayek when I was in college, and so he was always a thinker that I respected a lot for a lot of things. But it was when I was stumbling into this space, I was like, oh my God, look at this. He's written about this, but very, very different set of ideas there, but very, very relevant here in this conversation.
Yeah. And, in some sense that, it's thrilling that, the denationalization of money is kind of occurring, at least in part.
Yeah.
But I also think that we have insufficient appreciation for some of the monetary thinkers in these conversations where their ideas are salient, even though they weren't writing about cryptocurrency per se. They didn't know it would exist. Like, for instance, in the discussion of Ethereum versus Bitcoin from a monetary perspective. So on the one hand, Ethereum will likely figure out how to become more disinflationary or even possibly deflationary in the monetary sense. Now, of course, if I'm being pedantic, I would say deflation is more a function of the sort of aggregate price level. Mm-hmm. And so you would say if the coin is appreciating, it's experiencing deflation. So you could say ETH is deflationary today.
Yeah.
Right. But there's just the two definitions of inflation. And it's funny that we use the monetary.
Yes, it's all relative to what and what's the real world purchasing power. You have to always measure it against purchasing power of real world goods and services. And
yes, I mean, so under that definition, both Bitcoin and ETH are just structurally deflationary, even though they have positive monetary inflation. But we don't have to have that debate right now.
What curve are you looking at, kind of thing, right? Yeah, is it the curve against the dollar or the curve against itself, right?
I certainly think that Ethereum will be able to achieve that, a less issuance-heavy sort of outlook, for sure. And I think they'll be successful in that transition away from proof of work to proof of stake model. Moving towards sort of a roll-up space, scaling model. I have a bit of a contrarian view. I don't think that will reduce fees on Ethereum for a number of reasons. But, I think generally speaking, they'll sort of achieve their objectives. And then the question is, do they have more monetary credibility than a Bitcoin, where Bitcoin just sort of has these ordained rules and we adhere to them and we expect them to hold indefinitely. Whereas Ethereum has a kind of a design philosophy, but less rigid rules.
Right.
And they're optimizing for other things like sustainability of the miner or validator budget. And, they'll tune the monetary policy around that. So it's just a sort of more multivariate design analysis. And so I think if you think back to the sort of pre-crypto monetarist literature, and you look at what a lot of these thinkers were looking for, it often centers on these, can we design a monetary rule that satisfies a few, criteria? It produces price stability. It's sort of apolitical. It eliminates discretion, political discretion. It creates an independence for, the authority of the central bank or whatever it is.
Right.
And is such a rule possible and practicable? Like, can you actually politically instantiate such a rule? And of course, the answer was always no, because what central bank will submit themselves to some, superior rule which says, target nominal GDP or whatever? And that was never possible. And I think that was the beauty of Bitcoin initially, is that it was completely outside of the system. It didn't try and change the existing system. It was just this completely novel system, and proposed a different rule set entirely, which was alien and all central bankers hated. But it didn't even seek to engage with the institution of central banking. It just proposed its own thing. So we made progress towards finding a stable, non-discretionary monetary rule. Now, was it the correct rule?
Right.
Is another question. And so then if you look at Ethereum, they don't have a non-discretionary rule. There's certainly discretion. And so that's where I would say the potential for error creeps in, is having a periodic assessment of the rule, because now there can be political motives that sort of creep in.
Well, yeah,
and so that's my concern.
Bitcoin obviously has the benefit of being very, very focused on what it's doing, so to speak. Whereas, Ethereum and frankly all these other next gen layer one blockchains are trying to be operating systems. They're trying to be application platforms. They're trying to support very, very diverse kinds of utility value for a very, very diverse range of applications for society. And the demands that exist there are to some degree paramount. And there's an interplay there. And that's an interesting one. Very, very interesting one to watch. And as I read, folks talking about ETH today, there is it's like this internet digital commodity money, non-sovereign. It has this great monetary policy, and it's this engine for X and Y and Z and so on. And that's generally viewed as like a really powerful thing. It's more utility value kind of argument. But it related to your kind of the discretion versus non-discretionary approach to monetary theory. Do the application utilities end up having an impact where you're going to be making decisions on the monetary theory that on the monetary policy that wouldn't necessarily be the right decisions for it as a commodity money, but might be the right decisions for it to grow as an operating system?
I think it's actually, the risk is the reverse, which is that you are motivated by a monetary motive to make decisions which actually impair the utility of the system.
Right.
And so I'll give a very simple example. EIP-1559 was, a new change that was added to Ethereum recently, which changed the core fee logic and introduced this notion of burning coins for some portion of the fees. That had the net effect of reducing issuance of Ethereum, which from an investment standpoint is really attractive. I think that really led a lot of the rally.
Yeah.
And however, it introduces this different set of incentives across different stakeholder groups in Ethereum. So on the one hand, you have sort of token holders and people that are holding Ethereum in expectation of appreciation. And then on the other hand, you have people that are using Ethereum from a utility perspective because they value the block space, and they like the settlement assurances that you get from Ethereum. Now, those two groups are now in some sense at odds with each other, in my opinion, post EIP-1559, because the first group wants fees to be structurally high so that lots of Ethereum is burned. And the second group is suffering the cost of those fees. They are providing the subsidy in the form of high fees to the first group, because their economic activity, a portion of that is sort of siphoned off and burned, retired effectively. So it's like this ongoing stock buyback in retirement, which is good for the monetary policy, bad for the transactors.
Yeah, I mean, I face this all the time, right? So
I mean, you're a perfect example of this.
Absolutely. Like, I mean, there was a tweet today. You know, someone was like, I sent $100 in USDC, and it cost me $200 to send the $100, and it was kind of like, what's the fucking point, right? And you know, something like a stablecoin, you know, on a layer one that's got these kinds of fees, like it basically makes it only useful for whales, right? Only useful for people who are doing like much larger transactions. They want the finality, the speed, the security, the interoperability, all that, but it sort of prices that out. And now we're faced with this because generalized adoption of layer twos it's not here. And it, you know, it's one of the reasons why we've been focused on multi-chain in USDC as a protocol, is because like we really believe, like from a utility perspective, like we need more scalability, we need more, you know, capital efficiency, we need more cost efficiency, and we believe that there are layer ones that are doing that effectively and have the potential to be very decentralized and provide, you know, that use case. And it may be that, you know, ETH is just not able to do that, at least for some time. So we face that. We face that with our customers too, like NFT. We have a lot of companies that are building NFT projects, right? They're NFT this, entertainment, NFT that, musician, NFT whatever, right? You know, all these NFT projects, which, you know, they don't care about the monetary, you know, theory here. They're like, I want, you know, to be able to have this seamless way to enable the sale of digital property and make it as mainstream as possible, right? I want to connect people so that they can interact with that. And, you know, it's kind of, the economics are insane. And so other than, you know, marketplaces where there's just everything's priced out and it's like super speculative, right? It's really challenging. And so you're seeing that clash of utility versus, you know, the monetary incentives happening, I think, right now in front of us.
Yeah, and I think it wasn't really a big consideration for the Ethereum community when they were debating that EIP, that it could actually set these stakeholders at odds with each other. But I think it's clear that it does. And so then the big question is Ethereum block space a commodity on an even par with other genres of block space, like other blockchains, whatever it is, Avalanche, Solana, Polkadot, Near? Are they interchangeable and sort of fungible with each other? Or is there something really special about ETH block space where people are going to pay a structural premium to use it?
Right.
You know, an advantage over these other ones.
Right. I mean, it's all about network effects of ecosystem and installed base of like wallets and end user access and tooling and, you know, this kind of stuff. But, you know, having my own view is like, having been through many platform wars, developer platform wars, from the early 90s through today, right? There are these big generational changes that no one can anticipate that happen in terms of what platforms people are building on. Like no one can predict them. They happen though. And so what I always assume is we don't know what platforms we're going to be building on in 5 to 10 years. To say we know is just ludicrous, because that's just never historically been the case. Because there are new either physical devices or you know, or distribution paths or other things that kind of emerge that do that. And I feel pretty strongly that that's going to be the case in the blockchain operating system space. I think of these more maturing third generation chains as competing in the internet operating system space. And nothing's a foregone conclusion at this point, in my view.
Yeah, and this is, I think, what's so interesting, because also I think the presence of USDC actually materially changed the outcome here, right? Because USDC is portable across chains, and so it allows you to more frictionlessly have your exit cost is lowered from a certain block space.
Yeah.
And so it makes it more competitive because liquidity is now mutual across
Yep.
many blockchains. Where that just was not the case 2 or 3 years ago.
Right.
So in a sense, you're accelerating the conflict here between these different transactional spaces.
I don't want to think of it as accelerating the conflict. I mean, I think we're
market-based competition.
Market-based competition. Thank you. Yes, definitely seeing that without a doubt. Which is maybe we'll segue a little bit. So, sound money theory. Kind of if you anchor things like what we were talking about with Bitcoin or the monetary policy of Ethereum and there's sort of sound money theory behind some of these. But, there's also sort of sound money theory as it may apply to fiat currencies as well. And, and in fact, that it can apply to even fully reserved asset-backed fiat stablecoins. And, I think, you've written about and talked about stablecoins a lot. I know you've called them crypto dollars. We'll call them stablecoins for
Didn't catch on. I tried.
Look, we didn't choose the word stablecoins. Like we were in 2017 when we put the Center white paper out and around USDC. It was fiat tokens, which obviously did not take hold either. But in any case, so I think. One of the things that I've been really interested in is what is sound money monetary theory as applied to the utilization of fiat money and its expression in a digital currency world, its expression in a public blockchain world. And actually, when I launched the Money Movement series in the height of the pandemic last spring, what some of the early guests I had on were people who'd been thinking about, writing about, studying the Chicago Plan, which was Irving Fisher and a whole host of other very influential Chicago school economists following the Great Depression, who basically had seen all the bank runs, and it was the run on the bank. And why was there a run on the bank? Because banks were fractional reserve lending, and they couldn't meet their obligations. And the classic, the kind of classic story, and that risk taking led to deepening of the Great Depression, and so the theory obviously was that it was possible to effectively separate the sort of storage of value and payment utility side of banking into a full reserve model, and separate that from the provisioning of lending, and not have banks be in the business of creating money. But you're still having essentially the government debt, or back then it was gold-backed treasuries, and so we could talk about the base M0. What is M0 in practice in a fiat money world? That's just a whole nother discussion. But let's put that aside for a second and come back to even, like, we're going to take for granted that somehow the purchasing power and the rate of inflation and the management of that is sort of reasonable, say in the Eurozone or the dollar economy. Again, put aside that discussion because I think that's a debatable, obviously, right? But just assuming you have that, is the construct of a full reserve dollar digital currency feasible to actualize the needs of the economy, of the real world economy? And the argument has been, banks need to be able to create money, and monetary policy and the role of the central bank in kind of pricing that is how you incentivize credit velocity, money multipliers, other things like that, and how you contract it as well. And I mean, that's pretty dogmatic right now. Like, and the alignment between the central bank, fiat currency central bank policy, and the two-tier banking system, and the role of banks in creating new money. And we have taken a view that you can have a full reserve monetary system, and it can actually be safer and more resilient. And there is a way to apply sound money theory in the fiat world and in the stablecoin world, and those debates are being played out right now. But I'd love, maybe I just laid out a whole bunch of stuff, but I'm interested to hear you unpack some of that and share your thoughts on stablecoins and their relationship to these monetary theory questions.
Yeah, that's so much to cover there. I guess there's a difference maybe in terms of sort of like what's the most prudent approach to regulating stablecoins with regards to sort of what the characteristics of the institutional characteristics should be. So, what are they holding? Who regulates them? What are their obligations? Are they fiduciaries? What are the claims and liquidation of the creditors, effectively, or the note holders, whatever you want to call them?
Token holders.
Token holders, I suppose. Yeah, I always think about it in as an analogy to people holding banknotes. I think of stablecoins as banknotes issued by private entities, just digital banknotes.
Well, I mean, our M2 money today are like banknotes that there are rules around how much risk they can take, but it's really just an IOU against the debt, and investment strategy of the underlying institution, right? It's a Chase dollar,
right,
is different than the whatever Bank of Argentinian dollar, right? They're really different, different characteristics for what that IOU represents.
Yeah, but at least within the U.S., there's they are treated as equal.
They are treated as equal, yeah. Right.
And the solvency of the institution doesn't matter as much because there's the underlying guarantee. So, there's the one discussion of, well, should stablecoins be e-money issuers, and should they be only holding extremely liquid assets underneath them? But then I think there's maybe the more interesting discussion that you're hinting at, which is, is there a possibility for a banking system that's sort of Rothbardian in nature and is a full reserve system? And what would that look like? And my mind strays to prior private banking systems where effectively there was very little regulation from above. And people in the U.S. are a lot of our policymakers and regulators talk about the quote unquote free banking system from 1830s to 1860s in America, but that actually had regulation. There was actually a good deal of regulation there. And arguably the regulation is what, in my view, caused a lot of the issues with that system. But if you look at truly unregulated private banking systems and what their characteristics were, I would think back to Canada during the same period, or Scotland from 1714 to 1844, or there's Swiss episodes or Swedish episode, and those were not full reserve systems. They were actually pretty fractionalized. So you'd hold as in Scotland, because no one really wanted to ever redeem the banknotes for the gold, they would hold 2 to 5% of the outstanding value of the notes in gold, in specie. And because it was a plural system of note issue with a number of different banks issuing notes against their reserves, the notes would just ultimately clear through a clearinghouse, and the banks would settle up against each other. And so there wasn't often an outflow of gold from the banking system. And so because that was infrequent, and also because the banks had sort of some contractual ability to suspend redeemability for short periods of time, they would actually pay interest when they did that. There just wasn't a need to hold a huge amount in reserves. And so they developed a pretty efficient system of holding, a pretty light reserve. And, I think George Selgin is probably the number one academic who's written about this, which is at equilibrium, if you eliminate like regulation and constraints, where do these bank systems equilibrate in terms of the quantity of credit? Because of course there's no shortage of credit being created. Scotland was industrializing that period. It was a very productive, economic period. And, I'm not sure you actually get in the wild, so to speak, these full reserve systems as the basis, because, banks ultimately just want to make money, and it's more difficult if you have a full reserve and you're acting as, there's a legal term for it, bailment, I think, where you're custodying coins and you're just holding them in the bank.
Right. But in a world where, effectively the money exists on a public blockchain infrastructure where it can be programmatically and contractually locked and utilized at the speed of the internet to any endpoint on the internet, and where we're approaching a world where the cost of even flash lending, 10 USDC is a tiny fraction of a cent, and you could have that available in a credit pool for minutes or hours or things like that. Like, I feel like a lot of these models were, and even fractional lending itself, were sort of based on the capital inefficiency of what it took to store value, move value, reclaim value, etc. But in a world where it's all instantaneous and it's all frictionless and it doesn't cost anything, and you have programmatic, perfectly secure and auditable and transparent kind of control functions, right? It feels like you could potentially build things that are both safe and create money velocity. That's just a theory I have.
Yeah, no, that's a great point, actually. I agree. I think in crypto land, you just need a lesser monetary base to satisfy the same amount of commerce, right, as you would need. Because settlement is so fast.
Yeah, and I know it's not a perfect view now, because the use cases vary so much, but like the velocity of money in stablecoins is so much higher than the velocity of money in M2 money, like dramatically higher.
Yeah, I haven't looked recently, but we also have to be careful with. I'll caveat one thing. I know I'm like partially responsible for some of that data, but I think the actual velocity calculation in legacy world is something like GDP divided by monetary base, if I'm not mistaken. So, you take the final value of the goods and services and you strip out the intermediate transactions and you strip out securities related transactions, and then you divide it by monetary base. So I would caution that it's not necessarily like with like, because frankly, we don't have a crypto GDP figure as much as I'd like to have one.
That's right. No, I think that's right. You're if there's like truly like financial transactions that are for financial, activity, it can inflate those very, very significantly.
Yeah, but the ultimate point is just, stable coins at what, I don't know what the aggregate value of them is, 130 billion, something like that. They're satisfying just an enormous quantity of economic transactions on a par with other, major payment methods. Probably a couple order of magnitudes below what FedWire does, but rival with your Visas and your PayPals for sure.
And growing fast, right? We just crossed $2 trillion of value transacted in USDC.
That's USDC alone.
Yeah, which is
it's pretty incredible. For something that's effectively 5 years old or less. Not
even like 3 years old.
Yeah. I meant stablecoins in general.
Stablecoins in general. Yeah. No, it has grown immensely. I know we're coming up on time, but I want to maybe and like we could definitely talk about a lot more for a lot longer. We could maybe next time do a 2-hour episode or whatever it is. Yeah, maybe just a closing thought. Totally transitioning to a very, very different topic, which is we started talking about distributed companies, and I'm very, very interested in what's happening with decentralized corporate forms, on-chain corporate forms, DAOs, as they're talking about. Although someone on Twitter was saying no, they're DOs, they're decentralized organizations versus decentralized autonomous organizations. What are actually autonomous?
Right.
It's just decentralized organizations. So DOs and DAOs. It really feels like, to me, I think of public change as sort of like a new global economic infrastructure that we can build on and experiment with. And it really feels like we're seeing the birth of new kinds of micro economic units of organization that have just never been possible, right? So that they're there. What are your high level thoughts on this space, and what are you most excited about?
Yeah, and I see venture funds investing in DAOs directly now, and just facing off against often an anonymous group of individuals, and it's incredible. I mean, we haven't been quite bold enough to do that from our firm just yet. We like to sort of know our counterparties, if it's for putting money at stake. But yeah, I mean, the growth of DAOs, I guess we can't call them DAOs after that. That's honestly a great point. They're not autonomous.
Yeah.
It's really surprised me, and the fact that now there's just an industry of probably tens of thousands of people that work for these entities.
Yeah.
I remember back in 2017, I interviewed at Fidelity for the role that I took there, and I sat down with the head of their sort of private internal pool of capital they have there. And he asked me for my long-term predictions around the crypto space. And I said, economic activity will move away from being organized by corporations, and it would be organized on chain.
Of course.
And at the time, I don't think there really were any DAOs. I mean, I'd been sort of inspired by the DAO, as in the
the DAO, and it was like part of the white paper, Ethereum white paper, and it was like,
yeah, but it was very theoretical, and of course the DAO was an enormous failure, kind of a disaster, and I just got such a raised eyebrow at that statement when I said that, and I think they sort of just forgave me for saying something like that.
I led with that at the kickoff of my company All Hands event a week or so ago. I was like, this is actually the long road here is we're back basically rebuilding economic activity around these units of organization that are going to happen on chain. Like that is what's going to happen.
Yeah, I think it's correct. And I think there's so many advantages. Like, for instance, and when I talk to regulators about this, their eyes actually light up, which is, it takes a lot. It takes a lot to do that. But, when you say about how you can get a real-time financial statement on a per block basis, if you're looking at cash flows that are on chain and it's fully auditable and you can actually trace through the cash flows and balance sheet and the income statement programmatically, you don't actually need an accounting firm to do it. They tend to sort of start to understand.
Yeah.
The caution I would urge is, if you think about the joint stock corporation, that was pioneered, I want to say, in the 1600s.
Right.
And then it wasn't really refined for
the late 1800s, really,
a couple hundred years.
Industrial revolution kind of, and global expansion.
Yeah. I mean, we didn't have limited liability corporations for a long time. Public equity wasn't really a thing for a long time. And so real securities markets didn't develop for a long time. And then corporate governance, of course, just took hundreds and hundreds of years to really refine.
Right.
And then, we had the American model of common law corporate governance, which is sort of the dominant successful model. It just, that's the way common law works. It incorporates all of these sort of case studies and failures and edge cases, and then it incorporates them in sort of the body of the law. And it just takes a long time. Now, of course, things move faster these days, but I think we're going to have the same process with DAOs, where we have a lot of learning to do around how to actually organize these things and structure them.
Yeah.
And do we create legal wrappers around them or not? And do we have vesting? And how do we segregate duties, and how do we introduce accountability, and how do we engage in treasury management and
What
eliminate
happens when a
principal
DAO,
agent problems.
who resolves the dispute? Yeah.
Yeah, so and all of those things are accounted for in sort of the corporate governance literature, if imperfectly so in some cases. So that's basically my model. And of course, there's obviously many successful DAOs today, but I think there's kind of informal rule sets that generally govern those.
Right.
The DAO as current, like the notion of a DAO as currently structured, is sort of like very incomplete in terms of codifying the modes of activity, within that sort of like semi-corporate setting. So I do worry about that. It's not something that's like necessarily solvable. It's just that we have to learn with the passage of time what things can go wrong, and then sort of like how we deal with them, basically.
The merging of meat space with DAOs and common law and case law, and there's a lot there. It's pretty exciting. So well, cool. I appreciate you sharing your thoughts on that. And Nic, really enjoyed the conversation today. Always love to chat with you, and I'm glad we could do this and make it available to everyone.
Yeah, I appreciate the invitation. This is great.